delighted to be joined for this fireside chat by the fabulous Fabio Nattolucci, Deputy Director of the IMF's International Capital Markets Department and the point person responsible for preparing the IMF's Global Financial Stability Report. Fabio, before joining the IMF, was a longtime member of the Federal Reserve and survived about a year at the U.S. Treasury, if I recall. So
just because you weren't there.
So let me put a few questions to you, and then we'll take the audience questions. So I always think of the IMF's WEO as somewhat of a base case document, and the GFSR as exploring the WEO from the financing side and delving more into the tail risks. So obviously rates have substantially risen in the US and Europe. Economic activity is slowing somewhat. Warren Buffett said that one finds out who's been swimming naked when the tide goes out. We've seen some major bank stresses. So do you see the policy stance as restrictive? And what do you see as the major macro financial risks, and how concerned should we be or not?
So maybe I'll step back for a second and then get we think about financial stability risk and answer your question where risks are and whether it's sense of policy. The question I was asking before, like I'm free now to answer. So if you step back a few years, right? So we're coming from an environment where you had rates be close to zero, negative impact in some jurisdiction around the world. You had very, very compressed volatility, and you have subdued inflation. And so that environment that lasts essentially since the GFC to pre-COVID set up an investment environment, if you want, where people went out searching for yield. So taking duration risk, credit risk, using financial leverage, and so on. So we are in a completely different world now because of a series of shocks in this polycrisis world. There was COVID, the war, and other shocks where inflation is stubbornly high, way higher than the target. And where policy has been, monetary policy has been tightened to try to bring inflation back to target. That, in some sense, has changed the macro backdrop, right, and the policy backdrop. And I think that's what we have been seeing, essentially, not just the case in the US with the banks, the SVB and the other banks, but if you step back, what we have seen in the UK in the fall of last year, in that case involved banks as well as pension funds. What we have seen in South Korea, for example, with Project Finance ABCP, that involves bank, non-bank, and any possible policy measure that people can think and have been thrown to the system, as well as here in the US, that is primarily in our regional bank issue has been. But in some sense, the thread is the same. You're moving from a ultra-loose policy environment where the investment thesis has been one where you just go out and get risk, to one where liquidity is being withdrawn through the federal fund rate in the US, or policy rates, as well as shrinking the balance sheet, including emerging markets. One thing that people forget often that there were 15 emerging market countries that actually, 18 if I remember correctly, they actually use asset purchases even in EMs, right? Which was a new thing. And so that, to me, that's the backdrop. And so the real question, I think the real policy question then is, is this just a painful process of normalizing policies, the size of the balance sheet, and coming back to a macro environment where inflation is going to be higher, maybe rates will be higher, which I think from a financial system perspective, financial stability may be actually healthy. Or this is like the canary in the coal mine, and then things are going to start breaking, right? So you see some tremors in the global financial system, and then at some point there's going to be a big earthquake. In some sense, what we saw in the UK, some of those tremors showed up in part of the global financial system that had nothing to do with the gilt market and the UK pension funds, right? We'd heard and seen people that actually they had to close some position. They ended up selling CLOs in the US or some asset-backed securities in all the way to Australia, for example. So I think that's, to me, that's the big policy question. The system has been very resilient in the end. If you think again, all this series of shocks that we have seen from the banking stress now, the COVID, the war, and I think part is because you need to give credit where it deserves, which is the post-financial crisis reforms have really made at least the largest bank more resilient, right? So the G-SIBs of the world. Higher level, higher liquidity, resolution regimes, and so on. I think that's undeniable. We have also seen that a lot of risk has moved away from banks toward the non-bank financial sector. And so some of the risks may be there, and those are in some cases are more opaque. So we can have a discussion about vulnerabilities that link back to the banks. But I think the surprise here with the US was that the assumption, the operating assumption at least, was that if you make the GSIB safe, then the rest of the banking system will be safe as well. And I think we just learned that, first of all, there are banks that of size that is not too small, but large enough that if it's more than one, it can become systemic. Essentially, that a tail of the bank distribution can have systemic implication. And I don't think that was not how the system, from a resilience standpoint, post-GFC was designed, right? It was designed in a different way with other targets in mind. So that's, I think, a lesson to take from there. Maybe another lesson is that, and has been mentioned before here and there, that technology has played a role there, right? If you think a bank that in essentially an afternoon can lose $42 billion deposit, and then at opening there were another 100 on the queue to go out, that's on the run side. But then you think the policy tools that are available. I worked at the discount window, I was at the board. I'm not sure how you would react to that speed, right? There's no discount window button on your iPhone that you push and you get the money at the window, right? There's some steps, it's designed for a different world. So that's another part I think need to be reconsidered too. So, but overall, if you think about all these shocks, I think the global economy and the global financial system have been quite resilient. I think it's fair to say that, in part because of the policy response that we have seen to COVID, as well as to the banking turmoil here in the US.
It should stay that way. Well, I think I just heard you say that the banks on the whole are resilient, especially the big ones. Some concerns about others. But I've recently even heard that European banks may be stronger than US banks, which startled me. But be that as a case, there are a lot of mark-to-market losses on banks' balance sheets and whatnot, even if they're holding till maturity. So is it really the case that the banks are still strong and resilient?
Okay, so everyone, us included, have done the exercise of taking the held to maturity portfolio and marking to market, right? So Treasury, MBS, anything you have there. If you do that, and you do not just the banks, but with the non-bank financial institution, the system melts. It's not designed to be instantaneous mark to market the entire fixed income portfolio, right? This is how the banking system works. I could argue that it's in fact, once the Fed facility, the bank term funding program is in place, I can't imagine a reason why you would want to actually mark to market your entire hold to maturity portfolio, right? You can always go to the Fed. Now, the argument is a different argument, which is going to the Fed is expensive. That if you go there, you pay 5% plus. And also that if you touch one piece of the hold to maturity portfolio, you need to mark the entire portfolio. So that's a different challenge, right? And I think that's in part what investors are pricing when you look at bank stocks, or particularly regional bank stock, right? That there's a profitability business model problem. Because your liability side, you can't pay close to zero deposit. The deposit beta is going to go up. Money is getting out of some of those banks and it's going to money funds and other alternatives. So your liability cost is going up quite a bit. If you want to survive, you need to increase that. And then on the asset side, you have either this held to maturity portfolio that you don't touch, you can't touch, or you have, particularly for the regionals in the US, invested in sector like commercial real estate, with regional banks account for 70–75% of bank lending to the CRE. And it's a sector that it's a confluence of possible things in some sense that are concerning now in terms of vulnerabilities, right? There are regional banks, there are non-bank financial institutions like, I don't know, the REITs and the valuation of REITs, private credit markets there, the CMBS market, participation of foreign investors. So there's a confluence of things that could, in some sense, pose a challenge. So that's the structure of the banks, of the region, right? But on the liability side, pressure, higher cost, funding costs, and then less profitability on the asset side, plus likely more regulation coming for them. So, and I think that's what is being discounted. You don't see similar stress for the larger banks. You don't see it here, you don't see it in Europe. It's not Roma, I can assure you. But in some sense, this issue of held to maturity, so we looked at that, right? We tried to mark and see what will happen to the entire distribution of banks. Our calculation was that for the US, about 9–10% of the distribution of banks will actually fall below regulatory capital, so will have a significant impact. We've done the same exercise for other advanced economies, for emerging markets. I think one difference across these groups is one that while the securities holdings, the fixed income portfolio is high, also in other jurisdiction, but the held to maturity portfolio is smaller in other jurisdiction, both advanced economies and emerging markets. Europeans have a different approach to interest rate risk through Basel III, so I think some of it might be accounted for. And then emerging markets have other advantages if you want. That the share of short-term debt is smaller, so they are not facing the same challenges. Of course, emerging markets are much more bank-centric. The average credit quality of the loan book is lower than advanced economies. So they have other issues, but if you look at the performance of emerging markets through all these shocks, including the last one, and you asked me 2 years ago at a conference like this, if the Fed hiked 500 basis points, what would happen to emerging markets? If you just look at the investment grade spreads for EMs, it's flat for the last 2 years. So the performance has been extraordinarily strong.
Great. You and I have talked a lot about non-bank financial intermediation over the years. And obviously, after the GFC, we were worried that by regulating the banks much more tightly, that the risk would gravitate to NBFIs. But still, it's the case that banks interact a lot with NBFIs. So excess leverage in this interaction, one would think, should be caught by the bank supervisors, but maybe in SVP's case, it wasn't. And then second, even if a major asset manager, you could argue, is an amalgam of lots and lots of funds, presumably there still can be a lot of interconnectedness among funds. And if the funds are similarly correlated, there isn't much diversification in practice. And then stress can be quickly amplified, which is a major focus of GFSR. So, I mean, the FSOC hasn't designated any asset managers as systemic. I mean, should large asset managers, either for their activities or as entities, be viewed as systemic, and what should be done?
Okay, so there's a lot of questions here. Let me step back because you answered a question about the stance of policy, and I'll link to this that I didn't answer before. I forgot, I got distracted by it. So in terms of like one of the reasons why inflation is not coming down, right? And policy has been tightened. I think Chair Powell answered one of these questions during one of the last press conference by looking at the ex-ante real interest rate, right? So you take the fair fund rate, you take away, I don't know, whatever measure, inflation swap, tips, whatever you want to use. Say 1 year ahead, and you say the fair fund rate 1 year from now, it's 300 basis point plus positive in real space. I think that's true, but with one caveat, that if you do if inflation surprises to the upside consistently for a number of months, as we have seen over the last year, say, that means that ex-ante you are 200 basis point positive, but exposed you are consistently negative in real space. And that's what we have seen, I think, for a while now. So if that's one-off, I think it's okay. If it's repeated as a risk that at some point the stance of policy is perceived as not being tight enough, and that generates a different kind of investment behavior. I think that's what you hear from people. It is true that it essentially boils down to the inflation outlook, right? If your inflation outlook is for a year or so consistently too positive, too benign, the ex-post policy is to lose to bring inflation down. Another way to answer that question is if you take the 5-year tips real rate, for example, and you compare it to some sort of whatever you think the equilibrium real rate, whether it's Laubach measures or whether this is, I don't know, the SCP, that number is above the long run, but it's not so much above than it was in previous historical episodes when inflation was much lower. And so by that measure, then perhaps policy is not tight enough. And that's why financial conditions in the US, instead of tightening, have eased. And I think that's what fits into some of this concern of NBFIs, right? So the vulnerabilities that we have highlighted are primarily one of, say, duration risk, for example, credit risk, right? So we have few charts where, I don't know, life insurance, they have notably increased their share of risky assets over the last 10 years. Use of financial leverage by various NBFIs through derivatives, for example. But importantly, the point that you were making, or use of financial leverage, the financial leverage argument and the interconnectedness, right? And one of the reasons could be because maybe policy is not tight enough to actually squeeze some of these vulnerabilities. I think one caveat when we talk about NBFI, though, that we try to do in the chapter that we had, is NBFI is a very wide-ranging group of institutions, right? It includes relatively well-regulated institutions like insurance companies, pension funds, all the way down to family office, hedge funds, and others. And so when you look at this, they have different investment profiles, different time horizon, different vulnerabilities. So I think we need to be careful when we bucket them all together because the policy response would be different. Now, should be designated or not? I think the EPSOC did, then they de-designate, and there was a discussion about activity-based approach. I think I don't have intellectually an issue with the activity-based approach. The issue, it's more practical. The EPSOC is composed of 10 plus agencies, some with financial stability mandates, some without, some with tools, some without tools. And for activities that cut across all of them, like leverage finance, for example, perhaps some institutions, some agencies do have a mandate and tools to slow that down, but others don't. And so when you cut across activities, you need to make sure that the agencies involved actually have the mandate and the tool to do that. Otherwise, I suspect and fear that the activity-based thing won't work. This issue of designating, regulating, whatever you want to use, I think it's crucial when you think about liquidity provision, though, right? So my personal view is that if you want to have access to the central bank balance sheet, whether this is emergency liquidity, even more important for standing liquidity, you need to be somehow within the regulatory perimeter. And it happens at some of these institutions or not. And so I think it's important to think of these issues now, that if you want to have emergency liquidity going to some of the institutions, you need to find a way to have data availability, to have a visual into their activities, and have at least some tools that belong usually to the regulatory authority.
Well, we'll save 13.3 discussions for another day. So on the NBFI front, there's been a lot of press reporting that about private credit surging, lending from private credit entities and PE, for example, and whatnot. Anyway, is this something that's big enough to be on the fund's radar screen?
So we worked and we looked into this more than once. For a couple of reasons. One is because it's a sector that's grown significantly, right? So if you define private credit here as private credit funds, say BDCs and middle market CLOs, the outstanding, if you include the dry powder, it's about 1.6 trillion based on our estimates at the end of last year. That means that the outstanding now is larger than high yield and leverage loan, institutional leverage loan. So it's a significant rise from 200 plus, say 10 plus years ago to where they are now. So just the sheer size raised the question whether this is a systemic sector or not. They're also an important source of credit and financial services, right? So they contribute to growth in a positive way, but they come with risk. So unfortunately, there are no data. So all what we have done is has been mostly on the qualitative side and going out and just gathering information, talking to people. And I've spent quite a bit of time in New York, for example, doing this. I think there are some risks ameliorant there. One of them is that there seems to be no run rates, right? These are committed capital for say 10 years. So this is not an open-ended mutual fund. You don't put money in and out. The bigger question was up to what extent they use financial leverage. My understanding, again, based just on conversation with some of these guys, they show me what they do with numbers. They don't seem to use too much financial leverage. It's mostly collateralized leverage. It's not mark to market on a daily basis. So this is not like a total return swap. And it is collateralized. At some point with some frequency, there is either you provide more equity or you provide more collateral or you shrink. I think the risk though is that because this leverage is provided entirely by banks, there's a risk that there is essentially an entry back on the bank's balance sheet from the back door. I think that's the main concern. And the third piece is this interconnected issue also in terms of cross-border, right? Some of these investors are not foreign investors, right? So you have the cross-border aspect, and I suspect some jurisdiction could have visual into their, say, I don't know, if you work at the Fed, presumably, at least my memory, you'd have some visual into what the large peer banks, who are you lending to, right? If you provide some of these like lines of credit to these guys, if I pick bank A, I should know. I don't know if there is a view from the other side, from the borrower side, how many that specific borrower, where is he borrowing from, and what is the overall size. But I'm quite certain that there is not much information in terms of cross-border, right? There is not enough sharing. That's what the FSB in principle have been trying to do for treasury since I was a treasurer and so on, trying to do. So my sense is that Finally, the last point is, what is the concern then, right? If it's not necessarily financial stability, I think it's one of credit provision, right? So there's going to be, because it's grown so much into a credit cycle and business cycle that we have not seen, how the asset quality will perform if the economy slow down. And importantly, back to the question I was asked here before, whether that sector will be lessening the credit crunch, if you want to use the word, or you want to amplify the credit crunch, because they themselves will be shrinking future credit provision and make it more expensive. To me, that's the $1 billion question, right? Will they essentially offset some of the tightening the banks are doing, or will they amplify what the banks are doing?
Okay, so I'm going to ask you a complicated last question and then go to the audience. So basically, it's about two facets of possible run dynamics. So, so bank stress has resulted in a surge in money market fund usage. And these funds are heavily taking up the Fed's overnight reverse repo facility, which means there's less demand and liquidity for other private assets. That's the first one. The second, totally different, is concern about central bank digital currency. So at the first signs of stress, depositors might flee to CBDCs. And so it's no longer a world in which people line up at, like A Wonderful Life, where they line up at the bank. And what we saw in SVP's case was you could just run in a few seconds with your phones. So is that a huge blow on the future of CBDCs, or at least for wholesale CBDC, because I assume retails could be limited. Anyway, so there.
I'll start with the first one because perhaps can inform the answer on the second one. So when I was still at the board, I worked with Antoine on this issue on IRP. So I'm actually curious to see if his views have changed. But to me, the issue there, so separating IRP as a monetary policy tool, right? That's one issue, right? And I think in that sense, it's been quite successful. They've been able to hike the federal fund rate by 500 basis points, and the entire constellation of money market rates have come up more or less in sync. Whether that was meant to be temporary or is becoming permanent and has a permanent footprint in money market funds, that's another discussion. But from a purely monetary policy tool, I think it's fair to say that it's been very successful. The issue that we were discussing back then on financial stability was, and it couldn't be tested back then because there wasn't any bank run, whether during a bank run, the availability of access to essentially the Fed balance sheet, that would be an amplifier of the run. It would either incentivize the run or amplify the run. My view is that just putting numbers, right? So if you take during the month of March, there's been about, if I remember, it's 130 billion or so increase in our IRP. There have been $200 billion of deposit outflows and even larger increase into money funds. So clearly some money went out of the regional and smaller banks, went to money funds and got parked at the overnight IRP. Whether this amplified the run or not, I think that becomes much more personal and judgmental. I don't think personally that you need to see actual flows for the actual availability of Fed balance sheet to become a vehicle for run, because it still provides a floor in terms of return, right? And so it still essentially allows money to get out of the banks and go over an RP or somewhere else, because that's a floor for money market rate. So from that standpoint, whether it goes there or somewhere else, it's still an amplifier, if you want. Should we expect a larger number of money going into an RP, given how much money went to money market funds? I don't know. I honestly don't know the answer. To me, it's fair to say that if we learn something, it's that maybe having some circuit breaker there that could slow the run. If we think there is an issue, I think something that could be considered. I was in favor of considering back then. I remain in favor. Part of the discussion back then whether we should use price or quantity mechanism. I think the price mechanism, when your short-term rates is 5%, is not going to work unless you're willing to cut 200 basis points. I'm not sure the price will do much by itself, which I don't think they're willing to do. So when the level of rates are higher, just the sheer existence of that facility, you talk to a lot of people in the market, they will tell you that that's your opportunity cost in some sense. If you want to do anything, then I think it has to be done on the quantity side. whether this is individual cap for institutions that they're lower, whether it's the aggregate or a mix of price and quantities with auctions where you fix the aggregate and then auction out to the institution. I'm not sure, people can have different views. Now, what lesson that means for CBDCs? I think one of the lessons is that an alternative of access to central bank can become an amplifier. Obviously, there are differences, right? It's not obvious that CBDCs will offer an interest rate that goes up less much, right? And so then it becomes less attractive. Whether this is wholesale, retail, how much is available of access to the central bank or not, I think that would be an important design, right? How much is available and whether this receives an interest rate or not. But I think there is some, probably more work needs to be done to understand if and how much the OpenRP accelerated the run.
I mean, in a run, if people can run the CBDCs, they're going to run, they're not going to worry about the cost.
But that means that the 5% it's even better. It's an additional, I mean, the difference is that this needs to be intermediated by money funds now, right? And the CBDCs, you have straight access depending how you design it.
Questions? Antoine, do you want to comment on your former colleagues' views?
I think I agree with everything you said.
That never happens. What happened?
James. Negative or positive seniorage from this. But how should a central bank communicate its balance sheet strategy over time, across periods, given the existence of this carry trade that can solve lots of problems tool? Like in particular, should there be a target of that thing size, or should it just be inherently something that exists and is a bit like the international swaps? We could use them as needed. They could be as big as needed. Don't ask about it. Or should there be a target? How do you think about that?
So I think there is one piece, often the discussion is about Fed communication, forward guidance, whether you should, what to make out of the SEP, the dots, and whether you forecast for inflation or be more data dependent. The part in my personal view that has been missing in terms of monetary policy communication has been balance sheet policy communication. In some sense, has been used for QE, has been used for financial stability purposes, this separation principle thing. It took several months to shrink a little, and then you get SBB and the balance sheet jumps, but those are different kind of reserve. Having a framework and a communication, I think, would be very helpful in terms of communication of the overall stance of policy. It was decided not to do that implicitly by setting on autopilot, right? So it's going to shrink. I'm going to tell you how we do it over a number of periods of years, and this is how it's done. I do still think that having clarity on the objective of using balance sheets, even separating monetary policy from financial stability, under what conditions should be used, what is the exit point, what is the mapping between balance sheet policies and federal fund rate policy. I think that would bring some clarity, I think, into market, because some of the discussion that people are having in terms of QT was the impact of QT. I think that would certainly benefit from clarity from the central bank. So now they look at balance sheet. There is a composition effect too, right? There's the straight balance sheet in terms of asset purchases, and then there's the asset purchase, either asset purchase that they did in March 2020 or the facilities that have been set up now. Those are different sort of reserve. But personally, I think they will certainly benefit. The big question is going to be the question you asked, right? There is a currency component that is going to go on its own, and then there is what is the buffer where you're going to get to if you want to maintain this like large ample reserve system. What is the buffer that banks need? That buffer is going to be probably endogenous to the conditioning markets as well, right? How much liquidity you want to take, precautionary liquidity on top of the regulatory stuff. The September 19 experience, that number, it's hard to gauge in some sense, right? Not only it matters at the aggregate for the overall banking system, but also matter in terms of distribution within the banking system. Right? If the large banks have it, but the smaller one don't have it, you can still have an impact on money market rates. That's what we've seen in that in September. That's the big question. I think that's why I think some communication in terms of, again, objective tools, how you use it for what purposes, how you exit. I think that would be beneficial in terms of transparency and in terms of like understanding the reaction function of the central bank. That part right now is left on autopilot and left guessing in some sense of what would be.
Okay, I'm just going to pose one last question, and then we're all going to go relax and have drinks and have fun. Since the G in GFSR stands for global, you could probably spend an hour talking about this question, but let me give you 2 to 3 minutes about it. So China, local government financing vehicles, weak state-owned commercial banks, housing woes. This could have, if there were big financial stresses in China that pushed the growth rate down or created financial havoc, that could have big global spillovers. I presume you look at this quite closely in your GFSR. So just anything, good headlines for us on this?
Yeah, so we had a box in October of 2021, if I remember correctly, in which we're trying to map possible contagion channels, right? So starting with the property developers, how would that fragility there affect the macro housing sector in terms of house prices, in terms of sales? What would be the impact for both banks, right? Who's holding some of those mortgages, who's holding exposure to the property developers themselves, holdings of the NBFI, the Chinese version of NBFI, so the wealth management product, they hold a bunch of this, and we have seen when they sell, they can have a major impact. And also then link back to the local government, right? So local government revenue source come mostly from land sales, and so when land prices are collapsing, house prices are moving down, has a huge impact on the local finance. And there was a tight correlation between the financial position of some of the region, the weakness in the housing sector, they would become self-reinforcing. I think the part that it's more, and so some of it has played out that we are in that box. What we have seen lately that I think was more concerning is that we're starting to see some pressure in the local finance government vehicles. At a time when the local government have been asked to try to complete some of those housing projects that were not finished. So putting more financial pressure on the finances of those regions, and you start to showing up in some of these local funding, local vehicles. I think that's in some sense is the next steps of the contagion. Obviously, they have the tools to address this. The issue is, this is not liquidity anymore at some point, right? It becomes solvency. And when it's solvency, there is nothing the government can do to make solvency issues go away. It's a matter of losses on to which balance sheet they get allocated. Yeah, whether it's the government, the large bank, the local government banks, the household, solvency doesn't go away. It's not liquidity.
So I was wrong. Emmanuel, I didn't see your flag up. I apologize. You get the last word.
Just a question, and I know I'm taking time on David, so I'm going to be short and eventually go through this during dinner because that's a long question eventually or a long answer.
Thankfully, I'm picking up a training. I like a training like an hour.
Oh, you have plenty.
But I think, so you mentioned that in terms of financial stability, everything went well with the GSIBs. And what we've seen in the stress was mainly around the smaller bank area. But what we saw as well during this small tension, I won't call that a crisis, tension on the regional banks, what a flight to quality, was you cannot always fly to quality, which means also in this area, fly to GSIBs banks. And they became even bigger. I think they were having positive inflows where the regional banks were having outflows. And now we're going back to this 2006, 2007 situation where too big to fail, they are bigger than ever. So we have those top tier banks, JP Morgan, Bank of America, and the European ones, but everyone know them, become even bigger, and UBS Credit Suisse caused a real issue in Switzerland as being really the massive GDP elephant in the room now in Switzerland. And to me, raise the question, are we solving the moral hazard issue, or are we actually pushing the cursor and the pitch further away? And what's next in terms of regulation to deal with this issue? Where is the agent principal issue managed in this area?
So
Sorry,
the
that-
fund does, Mark knows this well, the financial sector assessment program. So if you go back and look the IMF FSUP for the US 2020 and for Switzerland in 2019, some of the issues that we had flagged are related to exactly this issue. So for the US, some of the concerns that were raised was about the, I forgot what word we used, but essentially the 2018 law in terms of tailoring and some of the possible consequences in terms of not only on the regulatory side, but also the possible implication for the supervisory posture that would trickle down from there. Similarly, for Switzerland, some of the issues were around the resolution regime, availability of resources, and how that was set up, and whether how it would be conducted if it doesn't need to. Some of those issues have been flagged. To me, it's the bigger, if I had to pick one issue that I would be concerned, is the issue of the resolution regime, in the sense that has been essentially used in one case, and then for one reason or the other, never used in different jurisdictions, in Europe, in other countries. So the problem is that a big part of the building block of the post-GFC regulatory agenda was exactly starting from a resolution regime. So if you take that away, because for one reason or the other it's not being used, one, has been very costly for larger banks, right, in terms of burden of resources. But if you also don't use, you miss an important part of the entire building that's been built up post-GFC. And I think that's something that we'll have to be, as a community, both the supervisory, the international community, think about what the implications are, right? Because if that system doesn't work, then we have a bunch of other issues, including moral hazard being one of them. I don't think moral hazard discussion during the middle of turmoil is the right time to do it. That's not when you want to have that discussion. But once you get out of this among the various postmortem, I think that's going to be one of those. Is the setup for resolution regime done in a way that actually will be used, can be used, needs to be modified, and so on? I think that's a discussion that, again, in Basel and other places will have to be considered.
I think another question for another day is what this means for the future of deposit insurance regimes. Thank you everybody for joining us today.